today, All in the Numbers. I'm Tom Perrone from New England Consulting Group. And before we get on with our program, I'd like to give you the contact information. So as we were discussing our topic, if there is something you want to contact us about, you can email me at necgginc@icloud.com or call me 203-530-6615 or write us. But of course, visit our web page where you can find a lot of information. And if you'd like to read a lot of articles on business planning, you can go to our blog, yourbusinessworth.com. Well, today we have an interesting topic. Today we're going to discuss the Secure Act of 2020 and look at the opportunities for IRA owners and the inherited beneficiaries. The Secure Act of 2020 that just came out in January. Many people know it as the act that really allowed people under age 70 to defer their RMDs, required minimum distributions, until 72. And some of us didn't make it. But another part of this act, along with many, was the inherited beneficiaries from IRAs treatment. And that basically was part of the act basically says that any non-spouse beneficiary must take distributions within 10 years of inheriting an IRA. Now that's different because previously, before the Secure Act, inherited beneficiaries could stretch the account based on the longevity, with the minimum distribution being paid out yearly while the balance of the account grew on a deferral basis. That made a big difference in regards to future values. But now, an inherited beneficiary, which is basically a non-spouse beneficiary of an IRA, must take it within 10 years of death. So we looked at this and said, well, what happens because of that? What are the consequences? Well, what you're going to see here is, I'm going to use a highlighter here, pen color. Okay, we got that. Take a look at over here where we have $500,000. If you look at the tables here, this is the RMD tables. So if I'm age 70, 71, that means on $500,000, let's say growing in 3%, this is the amount of distribution I'll get every year. And as an IRA holder, that's fine. But let's say you're in a situation where you don't need all of this money, or you don't want your inherited beneficiary to get clobbered tax-wise. Because if you died that first year, this is what they have to do over a 10-year period. And one of the suggestions would be, if that were the case, that you wanted to get the IRA into the hands of the inherited beneficiary, could be a child, is that you basically take more out, pay the taxes, and gift this difference to them. Because at some point, they're going to be forced to take it themselves, and this is a way of you getting this asset over. And the other part of that is you might be in a higher tax bracket than they are now, but upon death, they might be ending up being in a higher tax bracket because of this distribution. So we're really saying, if you don't need the money, start taking it out now, make gifts to your beneficiaries. You'll see in here, this is just showing you how long it would last if you just took your RMD, obviously to age 100 at 3%. And of course over here is making the gift. Now another suggestion could be to do this. This is the same chart, and you'll notice that $10,000, what we did here was we said take your RMD, but take an extra $10,000 out every year. And this would be your balance. So upon death at any given year, that would go to the beneficiary. But this $10,000 we could gift into trust. And that $10,000 would buy a life insurance policy. So if this person was age 71, here's that $10,000. It's going into a policy to build a death benefit of 120. This is a dividend being paid out every year. So consequently, over time, you could apply the dividend against the $10,000 and lower the net cost. But here's the cash value growing by letting the dividend sit in there. So not only are you leaving the IRA, but upon your death, you've got a death benefit that's tax-free. And you'll notice this is going up. So if you're 71 in relatively good health and mortality is 85, you could end up having a $215,000 tax-free benefit paid to your inherited beneficiary along with any leftover account that might be in your IRA just by taking extra $10,000 out. And in many ways, it's a wealth replacement tool, but we think it's not a bad idea of shifting IRA dollars in high tax areas by the distribution and getting it out earlier and creating a new asset for their estates. Getting into all the numbers, we are happy to always bring some educational value to the topics. Again, if you need to communicate with us, you can email us at necgginc@icloud.com or call me at 203-530-6615 or mail us at P.O. Box 3155, Brantford, Connecticut. Please do go to our website. We have a lot of information on the website that might be helpful to you, plus a biography of the members of our group, and also for business articles. You might want to visit us at yourbusinessworth.com. Thank you for attending.